Good. How are you?
Well, not good. I'm okay. I was upstairs and going to connect up there, and it never would connect. I mean, it says I have a connection, but it just the little wheel kept going. So I'm downstairs, which has two downsides. You'll see there's no camera because I have a light attached to the top of my screen that shines down on my desktop, and that's right on top of the camera. And I ran down here. Also, if you hear the dogs bark, it's because I'm downstairs with them now. So I don't know. I'll figure it out by next week. But in the meantime, welcome to Finance 334. What can I say? I can see you guys. But at any rate, let me show you what we're going to do here. Share my screen. I don't want to share my screen. I want to share. Well, I'm not seeing the one I want. Hang on. Let me get the one I want. I want this one. And I want to go back here. Okay. Now I'm where I want to be. I want this. Share that. Okay. Here we are at the main screen. I want to talk about the syllabus first. I'm going to put this down. If you all have any questions, anytime, feel free to ask. Feel free to interrupt. Okay, best way to contact me is always by email, always. Normally, I answer very fast, and I answer late at night because I'm a night owl. So feel free to email with any questions. This kind of outlines the goals and objectives for this class. It's a basic class in investments. We're going to look at all different types of investments, how you create a portfolio, how you set up an investment plan, etc. You do need my finance lab. So if you haven't gotten it yet, you do need to get it. It does count as part of your grade. You will need a calculator. If you've had 331, you've already probably got the Texas Instruments Business Analyst too. And obviously you have to have internet access. Now, the plan is for me to lecture through Zoom, and they should be recorded and I will post them. Hopefully I'll get my connection issues. I spent 45 minutes on chat with Netgear today to set up this extender to work upstairs. And I thought I had it. Well, obviously I didn't. Here are the My Finance Lab assignments. The orientation opened yesterday. Yeah. And the math, stat, and algebra view. I think I changed that one to where it's not doodled the end because there's a lot of questions in there. It's a review for you, but it's also a chance for you to get some extra points. So there. Let's see, School of Business. You've seen the things on academic integrity, class attendance. Do the syllabus quiz because I have to report attendance. So definitely go in there and do that. I completely understand if sometimes you can't get here or you can't get here on time. You can just let me know. If anyone needs accommodations on testing, obviously in a recorded class, it would be on testing, then go on and contact the Office of Student Disabilities so I'll get the notice and I can get everything set up. There's your grading. We're going to have 4 semester exams, comprehensive, final. The final being comprehensive is required by the university. My Finance Lab counts for 10% of your grade. But now let me say this. The My Finance Lab questions look a lot like the test bank questions, which are on the exams. So it's to your benefit, that 10%. And we'll talk about the investment project. I am assuming by now you've probably all used Proctorio. Online exams are required to be proctored. Proctorio is free. You have to use Chrome. You have to install, to take the syllabus quiz, you have to install the Chrome extension to do it. So be sure you're good to go on that. You need a webcam. It's going to record your screen. It's going to record everything. If for a test you cannot do that, you can go be tested in Oxford or at one of the regional campuses, but you'll need to make arrangements to have that happen. Okay, here's your investment project. It's pretty easy. want each of you to select an investment vehicle, a stock, a mutual fund, a bond, whatever. Let me know by next week what you choose. Decide now whether you would have bought it or shorted it, sold it, and then follow it from February until the day of the report. Describe what you did, what the forecasts were, how they changed, report on the prices week by week. How did it perform versus the market? Did you make the right decision? If you had bought it, would that have been a good decision? If you had sold it or shorted it, would that have been a good decision? This doesn't have to be exhaustive, just enough to cover the material and to do a little short in-class presentation. Okay, here's our assignment schedule. There we are. And I just did the introduction, and I am going to talk about chapter 1, which is fairly lengthy. For an introductory chapter, it's pretty long, but that's what I'm going to do tonight. Questions about anything so far? Chapter 1. There's our learning objectives. Every chapter has learning objectives right at the beginning. Our learning objectives for this chapter: understand what an investment means, what the process is, what the principal types are, what an investment policy statement looks like, common short-term investments, and we're going to look a little bit about careers that are available. The goal of investing is to grow your money. I mean, that's the whole point, to set long-term goals and grow your money to meet it. Now, an investment, investment is any asset you put funds in with the expectation that it's going to increase value. Portfolio is just your collection of those. The return is the reward from investing. And remember, you've got 2 ways to get return: income, which is cash, or an increase in value, which is capital gain. Now, here we've got different types of investments. Securities. They can be investments issued by firms, governments, or others that are a financial claim on the issuer's resources. Liquidity. This is an important one right here because it's got 2 dimensions. It's the ability to buy and sell quickly without significant loss in value. You could sell anything quickly. It's the without significant loss in value part that's important. Now, property are real assets. This is buildings, personal property, collectibles, that type of thing. Investments can be either direct, where you directly acquire a claim or ownership like stock, or an indirect investment. Anyway, direct or indirect. Direct, you acquire direct ownership. Indirect, that's getting it through a professional manager. Now, direct stock ownership. It's kind of interesting. Note how high the United States is. That's really not a surprise. They lead because, followed by Canada and Australia. What happened in the United States was back in the world wars, citizens were encouraged to buy war bonds to support the war, and it started, they introduced them to the process of investing. That's why it's so high in the United States. Now, attributes of investments: debt, equity, or derivatives. Debt is contractual. We looked at it in 331. We're going to look at it again. The investor loans funds in exchange for interest and repayment. Equity is ongoing ownership. That's common stock. Derivatives, my personal favorite, they derive their value from an underlying asset. Options. We can look at investments as being low risk or high risk. When we're talking about investment risk, we're talking about the uncertainty surrounding the return. Low risk is obviously going to be predictable, but low return. High risk, more volatile, higher return. The idea with a portfolio is to diversify, to hold different ones to kind of match that out. Short-term versus long-term. When we're talking about investments, short-term is maturing 1 year or less. Long-term is longer than a year. So stock and bonds are both long-term. Domestic versus foreign. Pretty obvious. Securities issued by U.S. companies, foreign issued by foreign companies. Back up there a second. Creating a portfolio, you need to match the risk you find acceptable to match up all of these different parts. Now, you've all studied the concept of supply and demand in economics. Well, it applies to the investment process. Households, that's you and me, we are net suppliers of funds. We may not feel like it a lot of the time, but believe me, we are the suppliers of funds. We do borrow some for house and auto and that kind of thing. Government and businesses are the net demanders of funds. They're the ones to support government operations, to support business operations. Do you see it now?
Yes, ma'am.
Okay. Y'all ought to yell at me sooner. Yell sooner, because I see it, see, so I can't tell. Okay, from the current slide. But I will back up a little bit. There's the chart, if you didn't see that. We are by far the biggest in investing. Okay, short-term, long-term, foreign. Okay, we may not feel like we're the suppliers of funds, but we are. Because we save money and we invest money. And so we are supplying funds to the demanders of funds. Now, somehow we got to bring all that together. We got to bring suppliers and demanders together. Financial institutions do that. Banks, mutual funds, insurance companies, all of those pool our resources to help fund loans to invest in businesses. The markets do that. This is where suppliers and demanders trade financial assets. Typically, we've got assistants, we've got intermediaries, brokers, etc. Here's kind of how it works. Here we are over here. We're the suppliers. Now think about it. If we had to pick out who we were going to supply money to. So we would be in charge of doing all the monitoring, doing all the research, deciding who we were going to loan money to, etc. And then we'd be in charge of monitoring it the entire time. Very, very work heavy. We don't do that. We do it through banks, savings and loans, pension funds, and through the markets, and the money gets there. Okay. Types of investors. There's basically two types. Individual investors, that's us. We can either manage our own funds or have a manager do it for us. Institutional investors. These are professionals. They earn their living managing other people's money. We think of them, let me say this, we think of them as being informed traders. A pension fund will trade a large volume of securities because they're putting them together. Hedge funds, pension funds, all do the same. This is what they do for a living. As an investor, you have a large variety of investments. You can pick short-term investments, common stock, fixed income, that's bonds, mutual funds, ETFs, hedge funds, derivatives. There's a whole list out there. We're going to look at most of these. Short-term investments with lives of a year or less. The most obvious one and the most well-known one, Treasury bills. They're very liquid. You can buy and sell them. They're a prime example. Common stock represents ownership, share of a corporation. You get dividends and you get price increase, so capital gains. Fixed income. Fixed income are bonds. They're long-term debt instruments. And there's convertibles that allow special fixed incomes that you can convert them into stock. Remember all this from 331. It should not be new. Preferred is an ownership claim, sort of. It doesn't have maturity. It pays a fixed dividend, but you just don't see a lot of preferred stock anymore, to tell you the truth. Mutual funds are incredibly popular. They are an amazingly popular investment vehicle. And most of you, if you're involved in a 401k or a pension fund, 401k with your employer, they're going to give you options through a mutual fund, something like Fidelity, because it allows you to pick where you want your money invested. It lets you construct a diversified portfolio, and you don't have to invest a lot of money. They come in all varieties, all different types of investment goals. Now, the money market funds are mutual funds that invest solely in short-term investments. ETFs, or exchange traded funds, they're a relatively new development. They're kind of like a mutual fund, except when mutual funds trade, they trade at the net asset value, which is the value per share at the close of trading. ETFs trade all during the day, just like stock. So you can buy and sell it, you can short it. ETFs, we'll cover these in later chapters. And hedge funds. These are specialized funds that pool funds from high-income investors. You have to prove that you are a high-income, presumably sophisticated investor. They're less regulated than mutual funds. They're not hedged. I mean, the name doesn't mean anything because they're certainly not hedged. And we'll talk about those in later chapters as well. And my personal favorite, derivatives. Derivative securities are what the name says. They derive their value from some underlying asset. Typically, it's stock, but it could be the weather, a commodity. Two types, basics. Options, like the name, it gives you the one who buys an option has the opportunity to buy or sell an underlying asset at a specified price for a limited time. Futures are legally binding. It's a contract saying that you will either make or take delivery of an asset at a specified price, specific date in the future. We'll look at those too. Other popular investments, tax advantage investments. Most well-known one, municipal bonds. Municipal bonds are tax exempt in the state of issue. So you live in Mississippi. If you buy mutual bonds issued anywhere in Mississippi, they're exempt from tax, from state tax in Mississippi. They're also exempt from federal tax. If I buy Mississippi mutual bonds, they're not, because I live in Tennessee. Real estate, not very liquid, but potential returns from it. And tangible assets, gold, collectibles, anything that you purchase in anticipation of price increases. These charts coming up on these tables kind of recap that, and they tell you where we're going to cover it in the text. Yeah, 12, 14. We're not going to cover these web chapters. So, okay, investment plan. Before you start investing, you need a plan. You can't just decide, I think I'm going to buy some Apple stock and go buy it, though that probably wouldn't be all that bad. You need a plan. You need to decide specifically, what are your goals? There you go. What are your goals? Be sure your investments are designed to move you that way. There's the elements of it. It's a roadmap. Write a policy statement. Consider your tax situation. We're going to look at investing over the life cycle and the business cycle. First thing you need to do, this is true in any situation, any goal you're setting. The first thing is, where am I right now? Where am I now? Where do I want to be? What am I going to do to get there? Those are the same questions you look at in a marketing plan, in anything else, any kind of goal setting. Where am I now? List your assets, current income spending, define your investment horizon. Are you trying to save for a new home, a new car, your child's college, retirement, a lake house? You know, what is it? Specify your goals. And you have to take a careful look at it says your investment philosophy. What we're talking about is your risk tolerance. If you deal with an investment advisor, they're going to give you maybe a little quiz or something that will try to hone in on exactly how much risk you want to take on. Because risk tolerance is a very personal thing. The assumption is that we are all risk averse to some extent, but different levels of that. In general, if I'm going to take on more risk, I want more return. How much risk can you take on and still sleep well at night? That's the question you need to answer. Set your selection guidelines. Are there certain things you don't want to invest in? Do you never want to invest in what they call sin stocks? Alcohol, tobacco, firearms, gambling. Say, or you always want to invest in environmentally active companies, that sort of thing. Decide who's going to do it. Are you going to do it yourself, or are you going to allow an investment professional to do it for you? Now, you got to consider your taxes, federal, state, and local, income, sales, and property. Active income, that's what we get paid to do. That's our salary, our wages. Portfolio income comes from investments. Passive income is from things you don't participate in. And we've looked at the tax rates. I think it might come up here. There they are. This was, I guess this was 2021. I am hoping that all of you are doing your taxes, doing your own taxes, perhaps using tax cut or TurboTax or whatever. If you start doing them early on, when they're easy, when the most thing you have probably is active income, you have a W-2 form. It's easy. Then, as your tax situation becomes more complex, you understand how what you're doing affects your taxes. I mean, you can give it all to somebody to do it, H&R Block or whoever. They can only do what you told them you did. They can only record what you told them you did. So it's better for you to do it yourself and know, okay, I donated all this year, and I did this and I did that. So I highly recommend it. Okay, capital gains and losses. You need to know which tax bracket you fall in, back over there. You need to know where you fall. Wherever you fall, that's your marginal tax rate. So it's right there. The next dollar you earn is going to cost you 12%. Okay, capital gains and losses. A capital asset is property owned and used, including anything, personal residence, anything. A capital gain is when you sell it and make money on it. You sell it for more than you bought it for. If you've held it less than a year, that's ordinary income. If you've held it more than a year, that's long-term capital gains. And the tax rate is different on that. And there's a Medicare tax on top of that. Capital loss, you end up selling it for less than you paid for it. You can use them to offset capital gains, and you can carry them forward a year. Okay. This is the rates on long-term capital gains. 0. Most of us would probably pay 15. Okay. Considering your personal taxes, the goal of tax planning is to get the maximum, basically pay the least tax you can. That's basically it. You have to look at your current earnings and what you think that's going to grow to. And obviously, you should take advantage of tax advantage retirement savings plans. If your employer sponsors a 401k, any type of profit sharing, you get in it. If you're self-employed, KEO and SEP IRAs, individual retirement plans, IRAs and Roth IRAs. It is to your advantage to participate in all of those that you can. I'm sorry, I'm sounding hoarse. Okay. Need to consider where you are in the life cycle. Most of y'all are probably in the growth-oriented youth set. Middle-age consolidation, income-oriented retirement. Growth-oriented youth, you can take on more risk because if the market goes down, you have a longer time to recover. That's the logic of it. Middle age, you start shifting to less risky. This is when all of a sudden you got kids going to college, and at the upper end of that, you're beginning to look toward retirement. So you don't want so much risk in your portfolio. Income-oriented retirement, now we're looking at preserving capital and generating current income with the lowest risk possible. If you've got a life cycle, there's a business cycle. Investments are affected by the economy. Current Gross domestic product, industrial production, disposable income, certainly the unemployment rate. A strong economy is reflected in expanding business cycle, and stock prices tend to go up. Big surprise. Bonds, on the other hand, interest rates in bonds, remember, the value of a bond is the present value of its interest payments and the face value. So when market rates go up, the value of a bond goes down. It's just a little table. Performance of stocks before, during, and after recessions. Just kind of interesting. Here's the latest one, 2007, 2009. During the recession, boy, it really dropped. But 12 months after, it was back up 16%. The takeaway from that, the average monthly return was lower in the 6 months leading up to the recession than during the recession in a lot of cases. This is 6 months prior. Now, liquidity. Two-dimensional definition. It's going to be in the middle of the slide. There we go. The ability to convert an investment into cash quickly with no loss in value. We're going to, you would want to have some short-term investments. You would want to have liquidity in your portfolio. Unexpected expenses, unexpected opportunities, either way. And we're going to look at the role of short-term investments. And there it is. It's to provide a pool of reserves for emergencies or to accumulate. Companies use short-term investments up there on their balance sheet to just park money until they need it. We can do exactly the same thing. They can easily be converted to cash. They have low risk. They do earn some income. Now, most of them they either pay a stated rate of interest or they earn a discount. Treasury bills and T-bills are sold on a discount basis. You buy a T-bill for $900 and 3 months later, it pays you $1,000. It's an implied rate. Advantages, they're very liquid. Short-term investments, particularly treasury bills, are extremely liquid. Very low risk of default. The disadvantages, low return. You could lose some purchasing power from inflation, but if you're talking about like a 3-month treasury bill, this is not Venezuela. We are not going to have that kind of inflation in 3 months. It's just not going to happen. And here we go. This table recaps common short-term investments, all of them, and it's in your book. Description, minimum balance, interest rate, federal insurance, passbook savings, negotiable order of withdrawal, money market. This is basically a banking account that pays interest, and most of them do now. Typically, you have to maintain a minimum balance, but at least you earn something on it while your money's sitting there. Money market account, asset management account. These do typically have minimum balances on them. Federal government, I-bonds. They're issued in denominations as low as $25. They earn interest. It varies with inflation. It is recalibrated every 6 months based on inflation. They're virtually risk-free. And treasury bills. And we'll look at the treasury bill auction process. They are issued weekly at auction. Sold at a discount. They are very liquid, and they're exempt from local and state tax. So that's a nice plus. CDs, issued by commercial banks, maturity a month or more. They're higher risk than treasury issues, but they're a good place to park money. Commercial paper, individuals don't get involved in commercial paper all that much. Well, it's an unsecured loan is what it amounts to. The denominations tend to be very high, and they're issued by very well-rated corporations. The reason it's 3 to 270 days is because if it goes over 270, they have to register it with the SEC. Bankers' acceptance tends to be related to foreign trade. It's like a post-dated check, but it's involved in foreign trade. And money market mutual funds vary with rates. It's just they invest in money market funds. Now, when considering short-term investments, are you wanting to save, in which case safety is more important, or are you trying to gain income, in which yield is more important? That's what's going to help you decide which one of those you want to use. Characteristics to consider: availability, safety, liquidity, rate of return, right there at the bottom. And we have another table that rates each of those things. This was rate in 2018. Availability, safety, government issues, T-bills and I-bonds, of course, are very safe. I-bonds are not liquid. Treasury bonds, T-bills are liquid. So that kind of gives you a place to choose what it is you might want to invest in. Now, how about careers in finance? Y'all are in 334, so you very likely are either majoring or minoring in finance, so you might be thinking about it. There's some of the choices: commercial banking, corporate, financial planning, insurance, investment banking, and investment management. And here's kind of what that is. Commercial banking employs more people than any other part of the financial services industry. And as an honest piece of advice, it's one of the best places to get a start in the industry. Banks typically hire a lot. Corporate finance. Corporate finance, if you want to move up the ladder in corporate finance, you're going to need a pretty solid background in both finance and accounting, because those two kind of meld together as they go up toward CFO or vice president of finance. Financial planning. These are people who work with individuals to invest for them and design their financial plan. They typically have the CFP certification. It requires, I believe, a college degree. It requires several courses and a test, and it does require continuing education to keep them up to date. With insurance, you're dealing with risk management and investment banking. Investment bankers are the ones who assist a firm in raising capital, acquiring firms. These are the ones who help firms issue stock. If you remember, we talked about that in 331, and we will again. Investment management. This involves managing money for clients. CFPs are the ones who are, I would deal with the CFP. My investment guy is a CFP. Chartered financial analysts are they're the ones back there making all the decisions for the mutual fund as to what to invest in. The CFA certification is very difficult. It's a 2-step process, 2 exams. You'll see some of the questions at the end of the text. And here's some average salaries for you. This was 2018, but it'll give you some idea. Commercial banking. There's a good one right there. Years of experience. So these are some places that you could start. Goes up to 160. Corporate finance. You make CFO above 300. Investment banking, 800,000. But you can get in on the low levels. Depends on where your interest is. Clearly, this is the winner in terms of salary, but it requires, look at this, 18 years of experience. This would give you some idea of the variety of career options that are available. And there's our learning goals again. Any questions about our chapter? I'll stop the share. You look thrilled. You can't see me, but I'm laughing. That was a fairly long introductory chapter, but whatever. Okay, let's look at, I think there's only 3 or 4 problems. We'll look at those, and I'll figure out what I'm going to do before next week so you can see me. I can see you, but it doesn't seem fair that you can't see me. Okay. No, that's not what I want. I want, nope. Chapter 1. That's what I want right there. Okay. If I can figure out how to share it, I'll get it. I want to share that. Okay. Are you seeing an Excel spreadsheet?
Yes, ma'am.
Fantastic. Okay. Problem 1 up there. Stephanie German, 40-year-old woman, plans to retire at age 65. And she wants to accumulate $500,000 over the next 25 years to supplement her retirement. She expects to earn an average annual return of 5% by investing in a low-risk portfolio containing about 20% short-term securities, 30% common stock, 50% bonds. Stefani currently has $44,300 that at a 5% annual rate of return will grow to about $150,000 by her 65th birthday. That's this right here. That's exactly what that is. Yeah. Stefani consults a financial advisor to determine how much money she should save each year to meet her retirement savings objective. I personally thought this was a little weird way to do it, but whatever. The advisor tells her that if she saves $20.95, there it is, each year she'll accumulate $1,000 by the time she's 65. So if she saves 5 times that, she'll accumulate $5,000. Make sense? Sort of. How much additional money does she need to accumulate over time to reach her goal? Well, you could just do it the easy way and say she starts with that and she wants to get there at 5%. She's going to need a little over $7,000 a year, each year. You could also figure she wants $500,000. She's going to have 150 from the 44. So you could look at it that way too. Either way you look at it, she's going to have to deposit about $7,333 a year. I thought that was a little bit of a peculiar way to go at it, but whatever. At any rate. Okay, this is a tax problem. During 2018, the Smiths and Joneses both filed joint tax returns. For the tax year ended December 31st, 2018, the Smiths' taxable income was $130,000, and the Joneses had a taxable income of $65,000. Calculate their taxes. Okay, here's the tax table for both of them. We'll just look at Smith because they both work the same. It's 10% up to that amount. Their taxable income went up that far, so 10%. Their taxable income is the difference between here because we're still headed for the 130. This is the difference between the 130 and that. That's their taxable income. So it's 10% of this, 12% of this, 22% of that. There's their total tax. Joneses work the same way. Then the part B, how much must Stefani save? Oh, I'm sorry. Calculate and compare the ratio of the Smiths to the Joneses' taxable income. What does this demonstrate about the tax structure? The Smiths' income was exactly twice Jones's, but they paid almost 3 times as much tax. So that's what they mean by progressive. Okay. Here comes number 3. I could make this a little bigger. Okay. God, this is long. Jason and Carrie Consalvo, both in their 50s. They have $50,000 to invest, and they plan to retire in 10 years. They're considering 2 investments. The first is a utility company stock that costs $50 a share and pays a dividend of $2 a year. Note that these dividends will be taxed at the same rates that apply to long-term capital gains. The Consalvos do not expect the value of this stock to increase. The other investment is a highly rated corporate bond. Here we go. Currently sells for $1,000, pays annual interest at 5%, so they get $50. After 10 years, these bonds will be repaid at par. Assume that the Consalvos keep the income from their investments, but do not reinvest it. In other words, they keep the cash. They will, however, need to pay income tax on their investment income. If they buy the stock, they'll sell it after 10 years. If they buy the bonds in 10 years, they'll get back the amount they invested. And they're in a 32% tax bracket. Whoa. Okay. How many shares of the stock can they buy? At $50 a share, they can buy 1,000 shares. How much will they receive after taxes each year in dividend income if they buy the stock? 1,000 shares times $2. It's capital gains rate. There you go. What's the total amount they would have from their original 50 if they purchased the stock and all went as planned? Well, they're going to get that, and they're going to get their 50. How much will they receive after taxes each year in interest if they purchase the bonds? Same amount. I think that should pay, say, 32. Yeah, it should. No, that one's right. It's this one that I want to change. Okay, there we go. E, what is the total amount they would have from their original 50 if they purchased the bonds? And which should they do? Well, look at them. It's exactly the same. They should be indifferent between the two. If everything goes as planned, they're going to come up with the same amount. And your last one. Number 4. Mike and Julie Bedard are a working couple. They will file a joint income tax return. This year, they have the following taxable income. $125,000 from salary and wages. That's ordinary income. $1,000 in interest, $3,000 in dividends, $2,000 in profit from the sale of a stock they purchased 2 years ago. That's long term. $2,000 in profit from stock they purchased this year and sold this year. That's ordinary income. How much will they pay in federal income taxes on item 2? Item 2 is the interest. Tax on the interest, 22%. It's ordinary income. How much will they pay in federal tax on item 3? Dividend income. There you go. Dividend income is taxed at 15%. Yep. How much will they pay in federal income tax on item 4? Profit on the stock. Long-term capital gain. How much will they pay on item 5? That's ordinary income, back to their 22. Add it all up. That's how much they're going to pay. These are really kind of relevant problems considering that we're coming into tax season. Okay, stop the share. Questions? This was kind of short for a first meeting. I hope I can figure out what to do about the internet connection. But I'm relatively techie, but not super techie. Okay, anybody have any questions? You know what we're doing. After this, I'm going to say, let me look at the schedule and see what I'm going to do. Pretty generally, I'm going to lecture on 2 chapters each time. This time was the intro. So generally, I will lecture on a chapter. We'll look at the problems. We'll take a short break. I'll lecture on the second part. Actually, next time, I'm going to lecture on chapters 2 and 3, and then we're having an exam on chapters 1, 2, and 3. So they're going to come around pretty quickly. Now, you can read in the syllabus, I do not give makeup exams, but so if you're unhappy with your grade, you can elect to have your final count for one of your tests. Questions? Let's see who's here. A lot of new names. A lot of you I know have not had. Question? No. Okay. I'm seeing a lot of names up here. I know I haven't had you in class before. So let me say a couple of things. Number one, I talk fast. So if you want to slow me down, I interrupt. I don't mind at all. It does not bother me a bit. Number two, I answer email pretty quickly and pretty late at night because I'm a night owl. So feel free to email me anytime you want to and ask anything. If you ask me in class to post something or to email you about something and I forget, email me about it. I used to tell the class when we were live in DeSoto, by the time I drove home, I'd forget it. Well, by the time I feed the dogs, I'll forget it. So it doesn't bother me a bit. Remind me. It's okay. I'm perfectly fine with that. If you have any questions, I had a colleague once who her saying was, there are no foolish questions, only foolish silence. Because if you had asked me, I'd have told you. Now, I've heard some that were darn close, I got to tell you. But yeah, I see you laughing up there. typically, any question, ask. If you don't ask, you'll never know. And I will definitely answer you at any time. Feel free. Okay?
Okay.
I managed to zip through that in 49 minutes. Yes, I did.
Mhm.
It won't go quite that fast when there's 2 chapters, but when there's a, and the honest truth is, when I taught at Christian Brothers University, we had an evening program for working adults. It was aimed at working adults. And they always wanted the syllabus for all classes like 2 weeks in advance because they said students want to come get them and get the book and read ahead. And I'm like, who are these people? I mean, I never read ahead. I mean, in all of my classes, I don't think I ever read ahead. You come to class and find out what I'm telling you we're going to do. So I never assumed that you even got the book yet, much less read ahead. So the first night is kind of, you know, after this, I assume you've got the book, you've got my finance lab, you've looked at what we're doing, and you'll be ready to go. Okay? Okie doke. Y'all have a good week. And I will try to get my internet problems resolved so I can be upstairs. The dogs have been really good. I have 2 little Maltese here, and they're pretty yappy. And normally, if they see something out the window, they'll hurl themselves against the window. But they're both back here in their little beds asleep. I don't know. It's different anyway. Thank heaven for tonight. Otherwise, I'd be holding one in my arms trying to keep them quiet. Y'all have a good week. If you have any questions at all on anything, feel free to email me. I'm here. Okay?
Thank you.
Thank you.